Welcome to Money Matters TV. I'm Mike Dever. I'm the CEO and founder of Brandywine Asset Management, host of the show for today. And I'd like to introduce my co-host, Eric Parnell of Great Valley Advisors Group. He's Chartered Financial Analyst and Chief Market Strategist. Hello, Eric.
Hello, Mike. How are you? Good to see you today.
You as well. And then we're also bringing on Jeff Watkinson of Watkinson Capital Advisors. They're municipal bond specialists. Hello, Jeff.
Mike, how are you? Eric, good to see you.
Jeff,
really good. Yeah, so, we do have some things we can talk about here early in 2025. There's been some changes. But before we get started with our discussion today and our show, I'd like to ask Eric a audience question we have here. It's from Thomas Jacobs in Philadelphia. How far down the road do you plan financially?
Well, Thomas, it's a great question. And really the answer is multifaceted, because really in terms of financial planning, you can break it across a number of different frames. And in a lot of respects, you can plan down the road for tomorrow and the events of the next few years. Maybe you're thinking about buying a house, or maybe you're thinking about sending a kid to college. That sets one frame. But then there's also the frame in terms of retirement, which may be further out, or in terms of estate planning that can go all the way to the end of your life. So it really is about taking your assets and segmenting them out into different pools and setting a time frame for each of those plans. So it really goes all across the spectrum, from things that could be happening tomorrow to things that could be happening 40, 50, 60 years from now.
And I guess, Eric, you could also just plan for legacy, right? Down past your death. And how do you want to be involved with things that are going on after you're gone?
That's exactly right.
Yeah. Okay. So for anybody else that would like to submit a question to Money Matters TV, here's how you can do that.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
Okay, now we're going to bring back our co-hosts here, and we're going to ask some questions and find out a little bit about what everybody's thinking with the changes that are taking place right now in the U.S., the new administration. It hasn't been boring. I'm actually going to start with Jeff here, because our new commander-in-chief is a big golfer, and I just found out right before the show Jeff's in the top 2% of golfers. So I think that makes you our lead respondent here today. What do you see happening, Jeff, in general, from what's taking place now with politics and geopolitics worldwide?
Thanks, Mike. For the record, I read that if you're a golfer and you've broken 90, you are in the top 20% of golfers out there. And I've broken 80 a couple times, and that puts you in the top 2%. So let's put everything in perspective here.
There you go. Yeah.
One of the big risks in our business with our clients is headline risk. And it's essentially watching the news, picking up a newspaper. A great example would be the New York MTA, Metropolitan Transit Authority, the subway system back in March of 2020, when the country was shut down and there was nobody riding on the trains. And mom and pop, the municipal bond asset class is 70% owned by directly and indirectly by individual investors. There's not a lot of institutional money there. And you read the paper, you see there's nobody on the subway. Oh my gosh, sell. And obviously, New York City cannot exist without a subway. It's impossible to get people around in Manhattan. We anticipate a lot of headlines going forward in 2025. We've seen how the president negotiates. I would recommend at least reading the crib notes on the art of the deal and how big to small, how Trump likes to negotiate, how he likes to frame an issue. And the issue that we're seeing is when we get to the tax cuts. The tax cuts expire at the end of this year, and there's going to be a lot of headline risk coming. There's going to be a lot of horse trading and bombastic headlines, and it's really important to not make a knee-jerk reaction, especially in the municipal bond space.
Well, wouldn't that also provide opportunities, those knee-jerk reactions that other people are making? It seems like with what you're talking about, Metropolitan Transit Authority in New York City, people were they panicking out of those muni bonds because of the COVID crackdowns? And did that make you advise people to buy? Was that an opportunity to do that?
Absolutely. It's unique with municipal bonds because 70% is owned by mom and pop. And there's a little saying in municipal bond land, you can always buy a bond, but when everyone wants to sell, there's not a lot of liquidity, and the market can temporarily get held up, and unbelievable opportunities present themselves because sometimes there's fire sale prices. It tends to happen, the Friday after Thanksgiving. Usually a lot of people are not in the office. Someone needs to sell something on Friday afternoon. You can get a great deal, especially with headline risk. If there is a liquidity crunch, it's always short term because sometimes it's a day, sometimes it's a day and a half.
I find that interesting. That it's a market that's, with all the technology and interactivity and everything that's taking place today, that you still are able to find and deal in a market that has Friday afternoon inefficiencies, not because something underlying fundamental, but maybe the guy just wants to get out the door and get to his vacation house, so he's unloading something faster.
Especially in the summer, Mondays and Fridays in the summer.
It's crazy. Yeah, I mean, I love it. There's a lot of inefficiencies still existing in the market. Now, Eric, you have a broader view. You take a full picture, big picture view of everything as the analyst at Great Valley. And where do you see things heading with what's transpired here with the new administration?
Yeah, no, it's a great question, Mike. As at Great Valley Advisor Group, we build asset allocation models for advisors to provide to their clients. And, both you and Jeff are absolutely right. There's a lot of headline risk. There's a lot of noise that's hitting the markets on a day-to-day basis. But the reality of it is that if you've put in place a proper asset allocation strategy, a long-term plan, it is designed to withstand and designed to absorb these types of headline risks that take place on a day-to-day basis. And it's, the long-term plan still remains in place. And there might be something that sounds scary that comes across on the headlines, but it's always important to remember that market participants will adapt, and the market itself will adapt to the news that strikes, that hits the headlines on any given day. And that could be, the threat of tariffs being applied to another country, a tariff war breaking out. It could be the news that some startup artificial intelligence company in China has figured out how to make a ChatGPT equivalent for a much lower price. It could be the breakout of a geopolitical event somewhere around the world. a properly constructed asset allocation strategy and a long-term investment plan is designed to absorb those types of shocks and continue working towards the plan. The one big key that investors should watch out for when it comes to any of these types of headlines, what is going to be the impact on liquidity either coming into the market or going out of the market? And those things don't necessarily happen overnight. Those things take place over time. So as you take in this news, resist the temptation to try to react to what's going on and instead accumulate that information in order to be able to make logical and strategic decisions around the events that unfold in the coming months.
So the long-term strategic plan you have and I guess allocation models, do they take advantage, like we were just talking about with Jeff Wilkinson on the muni bond side and the Friday afternoon, and maybe liquidity, you need to pick something up cheaper? Is there opportunity like that, or is that something that's built in, or do you essentially just say, oh, we've got an allocation model that's in place and we're going to maintain that, and it doesn't shift even if it thinks maybe we can buy this cheaper?
No, it's the beautiful thing about volatility. It's the beautiful thing about risk in capital markets and in investment markets is that people will react with emotion to the headlines that they're hearing on a daily basis. And it's the ability to maintain your cool and to strategically evaluate what's taking place. And it opens up tremendous opportunities associated with those types of events. We think about what took place recently here with the news out of China with that, basically the company named DeepSeek. Here we have a startup company out of China, so it's not in the US, a startup company out of China that made some impressive technological advances. But is this one single headline going to be sufficient in order to change the capital expenditure plans of multinational corporations, not only in the US, but also around the rest of the world? And is that going to happen instantaneously? And whether it does or it doesn't, does it justify a 20% move in some of the largest companies in the world that we saw on that day? So it's the ability to keep your cool and be able to see those types of outlier events taking place, and maintaining your long-term discipline, but also maintaining that ability to be nimble and step in and capitalize when others are panicking.
So does Great Valley Advisors Group do that? Do they actually step in, or do they advise clients to step in, and then buy something like NVIDIA when it drops 20%? Overnight.
It's an evaluation process that we've been going through with some of the volatility that's taken place in recent days, because we've seen some outsized moves, and evaluating to say, okay, well, what's interesting and attractive to buy, what might need to be reallocated away from. So it becomes a dynamic and something that we're doing on an ongoing basis. Maintaining that openness to when opportunity presents itself, because it's the one unique thing about capital markets and investment markets. When most people go into a store, they love to buy stuff on sale, and they kind of steer away from things that are expensive. When it comes to capital markets, people like to buy things that are expensive, and they sell things that go on sale. So being able to maintain that rational discipline that we apply to everything else that we do in our day, it presents a lot of great opportunities.
Do you see anything going forward that with these disruptions we've had and the tariffs and the DeepSeeks and stuff's going on, talk with Gaza and Iran, are there changes you're making to your models based on that you think are opening up opportunities today that weren't here 2 months ago?
I think the biggest thing that we have to watch out for is, certainly you have those daily dislocations, and that can lead to, dislocations in equity prices, and also on the fixed income side. I think the bigger thing that we have to watch out for as we go through the year is the cumulative effect of some of the changes that are taking place. It wasn't that long ago in 2022 where we had a massive outbreak of inflation. And it was the biggest outbreak of inflation that we've seen since the 1970s and the early 1980s. It was 40 years since we've last seen something like this. inflationary pressures have subsided meaningfully since 2022. But those inflation pressures persist. Interest rates are higher than they were, prior to the inflation outbreak of 2022. We still see services inflation that is, in the range of 4 to 5%, which is much higher than it was previously. The embers of inflation continue to exist. And when you have things like tariffs, if they're implemented in a broader way, or anything that disrupts supply chains, or in an environment where maybe there's too much liquidity in the marketplace and consumers have too much buying power, that can rekindle those inflation fires pretty quickly. So I think one of the biggest keys for investors to watch for as they go through 2025 is, are we seeing a renewed rise in inflation? Because if we do, that changes an environment where the Federal Reserve, up until a couple of months ago, was inclined to inject liquidity, add liquidity to the market in the form of lower interest rates, to potentially have to stand back and say, well, wait a second, maybe we need to raise interest rates in order to combat a new inflation problem that's starting to brew. If that takes place, that can have a meaningful implications in terms of how you're managing what's known as duration on the fixed income side. How long are you lending money out in terms of your bond investments? Something like that. You want to shorten duration and go with shorter term bonds if that type of scenario takes place more often than not. And then on the equity side, identifying companies that have pricing power and economic moats, the ability to raise prices if we're in an inflationary environment, and also have the ability, hey, we have unique products that nobody else can buy anywhere else. So we have the ability to raise prices if we do see that type of inflation and maintain those profit margins.
Yeah, I do think that I had heard somebody a week or two ago, they were saying, well, tariffs aren't inflationary. They had them, 5 years ago, and it didn't cause inflation. And there's just so many unconstrained variables when you're using that kind of an analogy. But the math is, if the lowest marginal producer raises their price, you're going to be inflationary. It's somehow that stack there's inflation, and I think couple that with maybe restrictive immigration policies, so you don't have the low cost labor that you might have had. It does seem like a lot of things are pushing towards more inflationary environment. If we can extend the tax breaks, I think that's great, but potentially inflationary, as well. So there's a lot of things I can see that would cause the Fed to hold off. Now, Jeff, with all this inflation potential, are you seeing impacts in the muni market? Is that something that people need to be aware of there, or is it just something you kind of go on as business as usual and you don't worry too much about that?
It's a good question. I mean, every day I get research on inflation and prices and what the Fed's going to do and the probability of the Fed's. We have to keep an eye on the Fed. You cannot fight the Fed. And we keep an eye on that. And then on the second hand, we look at supply and demand in the municipal bond market. And so we have to keep our eyes on both situations. And if inflation is hot and it looks like the Fed is going to have to either stay put or raise rates, that just means new issue municipal bonds are going to get softer, prices are going to go down, yields are going to go up. People are going to wait because they think rates are going to be higher. It's a fascinating development. It's fascinating just watching both of these factors play out. 2024 was, with the new issue market, every week, 2024 was a record year with new issuance in municipal bond land. And it took on a familiar pattern.
And was that due to was there a backlog or pent up demand, pent up need, I guess, or was it just part of a trend where people are going to market that way?
Election years are different.
Okay.
And then years where there's going to be a huge tax, the Trump tax cuts sunset, expire at the end of this year. So this happened in 2017. 2017 was the previous record, and the previous record of new issuance or new capital being raised in the municipal bond land was 1986 with the Reagan tax cuts. So, last year, everybody wanted to get their financing straightened out before the election. And now, the month of January 2025, the monthly issuance was up 20% year over year, 20%, actually 20% over average. And a lot of the players on the street, a lot of the municipal bond, the brokerage, the investment banks, they're anticipating even more issuance, over 500 billion, even 525 billion of new issuance in 2025 And it's wild. The familiar pattern happens every week. Monday, there'll be announcements. Okay, North Carolina housing, there was a deal today. Pennsylvania Turnpike. Okay, tomorrow we're going to raise $200 million, $500 million for a new deal. Okay, fine. You come into the office on Tuesday. You put your orders in. Okay, we like the 5% coupon with 10 years of call protection. We want 15, 20 years maturity. We put in for 500 bonds. All these deals have been attractively priced. The bankers want to get the deal sold and move on to the next deal, and they need to make it cheap enough with enough yield to attract buyers.
So is it better buying the new issues than something on the market?
The new issue market has been priced to sell to attract buyers. And the Bank of Americas, the Stiefels, the Piper Sandlers, they don't want the inventory still in their books. They want to sell the bonds.
Is it a good sign that there's more issuance, or is that a sign of these municipalities are short on cash?
No, they can't deficit borrow. Municipalities, state, local governments do not do deficit borrowing like the federal government. But is there enough demand to buy these bonds? And that it's a week, day to day.
Right.
Sometimes some event will happen in the world, and they'll put the offering off for a week. Hey, okay, we shelved it. We're going to try it again next week because of some type of headline risk.
Well, Eric, do you see the same thing with, where there can be deficit? How's the federal government going to be managing these increasing deficits? What impact do you see of that on interest rates? We were talking about other inflationary pressures before, but a couple $1 trillion here and there is a lot of money to borrow, and it seems like that just keeps accelerating.
It's funny. I can remember a time when the national debt at $5 trillion had people wringing their hands with alarm to say, how are we going to pay this debt back? Well, now we're north of 30 trillion, and people are asking the same questions. And one of the things that concerns me from a long-term investment perspective is that it's been the boogeyman for so many years, like, the national debt, and it keeps in the deficit spending, but it's never manifested itself to be an actual problem. But at some point, we're going to reach a threshold where it finally starts to become a problem. And one could look out over the next 10 to 15 years when we get into the 2030s and say, demographically, we have these entitlement programs, Medicare, Medicaid, Social Security, national defense, the interest to pay on this ever-growing debt. And we need to have the revenues in order to pay for all of these things. In an environment where the massive baby boomer generation is all in retirement, and the Gen Xers aren't making enough money at their peak earning years in order to provide the government with the revenue in order to pay for those things. So the question becomes is that as that squeeze continues to manifest itself, what is the willingness of the marketplace to lend money to the U.S. government in order to pay for all of these things and service all of these things? It hasn't been an issue up to this point. But at some point, when you're talking about economies, not only the U.S., but a number of economies around the world that have debt to GDP ratios that are in excess of 100%, or basically means that we have more debt than how much the economy is producing in output, history has shown that eventually comes back to become a problem. Is that a 2025 problem or a 2029 problem? Probably not. But at some point, that is going to manifest itself, and we need to keep a close eye on that.
Is there any possibility of going back to the mid 1990s when we were actually retiring long bonds and had a surplus that we were running? How would that happen? What would be a scenario that could make that happen again?
That's the thing, is that with politicians, if they're standing knee deep in the fire, they can really start to react. We've seen that in the past. We saw it during the financial crisis. There is that instinct in certain parts of the political spectrum to maintain that fiscal discipline. And that's going to be a key component. And that would be a key component that would foster confidence, is that if we got back to an environment, where we canceled issuance on 30-year debt for a few years because we had that level of fiscal discipline in the mid to late 1990s into the early 2000s. That's the type of thing, because investment markets are a confidence game at the end of the day. It's more of like, are you doing the right things in order to get your house in order, particularly on the fixed income side? If we start to see movement like that in Washington in that direction towards greater fiscal discipline, that's a great way to get out in front of any problem that might be, starting to fester out into the long term.
I think that's your best comment of the day, is the confidence game. I mean, it really is. And I don't see anything happening today. We're tweaking at the edges with, stopping paying for U.S. aid and different things like that are going on. But the reality is you've got there's no grown-ups in the room anymore that are sitting there looking at fiscal discipline. The Republicans used to have that sort of sewn up. That was their thing. Now they want to spend, like drunk sailors as well, right? So everybody's doing that now. I mean, it's been that way going back to COVID, when there was a race to see which party was going to give more money to the populace to make up for the fact that they shut down the economy. So I don't think we're going to get a whole lot of help on that front. Obviously, the only real way to do it is to grow out of it. Yeah. But we haven't been seeing that because we've been seeing debt continue to increase as a percentage of GDP, and we need to see that start to shrink before we actually, turn the corner, I would guess.
Absolutely.
Does that change? Go ahead, Jeff.
It's a frightening scenario. Do we need the flat line for there to be change? Do we need to hit rock bottom? And we're obviously on an unsustainable path with the deficit spending. And you get out of it with growth, you get out of it with cutting waste, and you get out of it with fiscal discipline. And it's a frightening thought.
Mm-hmm.
But that's politics. I want my next office. That's what I'm running for. And
well, you can get a lot of golf in if you're in politics. That's the good news for you there. Well, the interesting thing about confidence games is they last right up until they don't, and the change in attitude is abrupt. I mean, it's over a weekend. Like in Enron, these things happen practically overnight when people lose the confidence. Okay, well, I appreciate it. Thank you very much, Jeff and Eric. Enjoyed the show. Thank you for your insights. Our next guest on Money Matters TV is Drew Yancey, PhD of Telios Strategies. Till then, thank you for watching Money Matters TV, where your money matters. See you next time.